The goal of the presentation is to introduce you to the bond and stock analysis. You will learn the features of stocks and bonds and the steps involved in valuation process. As an investor or manager, you should know the fair value of the both instruments before making investment or financing decisions. Investors invest in bonds and stocks to generate a rate of return, and corporate managers use bonds and stock to raise money to support the growth of the company and support the day-to-day operations. Let's look at the bonds. Bonds are IOUs and nothing attached to it. They are also called as debentures. Subordinate debentures are subordinated to senior debentures. Mortgage bonds includes collateral such as buildings, plant, and equipment, and they are less riskier than the regular debentures. Eurobonds are issued in the foreign denomination to attract foreign investors and limit the risk exposure of foreign exchange. Zero coupon bonds do not have a coupon, meaning company does not pay interest on the bonds. They sell bonds at a discount rate. Most of the time, investors buy zero coupon because they end up getting a higher rate than the coupon rate. Junk bonds are high-risk bonds, and the issuer has to pay a high premium because of the risk involved in the bond. Callable bonds have an option to call, and the company issue these bonds to fulfill their needs when interest rates goes down. Callable bonds have the option to call, and company issues these bonds to refinance their needs when the interest rates goes down. The company issues convertible bonds at a lower interest rate with the option to convert the bond into stocks at a later date. And investors have choice to convert the bond at a predetermined price or the exchange multiple. Whenever there is a large bond issue, investor requires firms to create a sinking fund and deposit a portion of the bond issue yearly so that firm has enough money to retire the bond at the maturity. Book value is the recorded value at the time of the issue, and it also includes reinvested funds in case of equity accounting. Liquidation value is the value assuming that you're liquidating today. Liquidating value is always lower than the book value and market values because buyer recognizes the seller's situation. Instinct value is the fair value or calculated value based on the cash flows from the assets. Bond is an IOU, and bondholders have a claim on the assets and income of the company. Par value is the face value, and face value of US bond is $1,000. Sometimes company may issue baby bonds with 250, 500, and 750 face values. Coupon rate is the stated rate of interest the company has promised the lenders, and it is stated on the bond. Maturity date is when the company will return the bond par value to the bondholder. An indenture is an agreement between the issuing company and the bondholders, and it may include specific terms involved in the bond issue. The yield means the rate of return. The current yield means current rate of return of the bond. The bond rating shows the riskiness of the bonds. Financial service companies like Moody's, Standard & Poor's, and other rating companies rate all the corporate and public debt issues. AAA or A++ are the highest rated bonds. C's are high risk bonds, which are also called as junk bonds. Let's look at the bond valuation model. Bond valuation model suggests that value of the bond equals the present value of future cash flows. Let's look at the cash flows. There are two types of cash flows. When you buy a bond, you receive interest payments and maturity value at the end of the maturity. So bond valuation model equals to interest payment time PVIFA at a given interest rate for number of period plus maturity value times PVIF at a given interest rate for number of periods. The interest rate here is the required rate of return. The required rate of return is determined by looking at the interest rate of similar risk bonds today, and we will use this to discount the future cash flows from the bond. So the bond valuation model simply suggests that value of any given asset is the function of present value of the future cash flows. Now look at this example. A par value is given to you, coupon rate is 10%, and maturity is 10 years. Now you have three situations. One, our assumption is required rate is 7%. The second assumption is required rate is 10%. Third assumption is required rate is 13%. And let's compute the bond value using the three required rate of returns given to you. The example one, we are going to use 7% as the discount rate. And we're going to use the bond valuation model. Interest is 10%, which is 10% of $1,000 par value is $100. Required rate is given to you 7%. Maturity date is 10 years given to you. Plus 1,000 is the par value, which is also given to you. And interest rate, the required rate is 7% for 10 years. Using this model, we can use a calculator or a spreadsheet, compute the present value of the bond. If you're using a calculator, use the timeline. If you look at the calculator, there is a N, I/Y, PV, payment, and future value. That's called time value of money line. So use the time value of money functions and start with the number 10, then press N, then 7, I/Y, then payment, which is 100 PMT, 1000 FV, then press compute, and PV. This will give you the present value of the future cash flow as 1210.71. Now, when you're using a calculator, make sure learn how to use the calculator. This is a Texas Instrument. Here we have to use compute key to calculate the present value. Like HP, if you're using, you don't have a compute key, you just press PV to compute present value. So learn about the calculator before you use the calculator. Let's look at the second example. In this example, we are going to use 10% as the required rate. And we're going to go through the same steps. We're going to enter the 100 as the interest and 1000 as the par value. And interest rate is 10%, it's for 10 years. And using a calculator, compute the present value. When you compute the present value, the value is 1000, which is same as the par value. And the reason it's the same because the required rate, the current rate of the similar risk bonds and the bond you're holding is 10%, and that's why it is $1,000. Let's look at the third example. In the third example, we are going to use interest rate as 13%. So currently the market is offering 13% for the similar risk bond. And we're going to compute the present value of the future cash flows. Cash flows are the same. 100 is the interest payment, 1000 is the par value at 13% for 10 years. And when you compute the present value, it comes out to 837.21, which is lower than the par value, which means the bond is selling at a discount. Why? Because investors have option of making 13% in the current market. That's why the bond is selling at a discount. This exhibit shows the relationship between bond value and the interest rate. Market interest rate changes, but the coupon rate remains the same when the bond is issued. So let's look at this bond. Coupon rate is 10%. What if the market rate changes to 10%? The bond value is going to be 1000. Why? Because the bond you're holding is also offer 10%. If you take $1,000 and buy another bond in the market with similar risk, it will also pay you $1,000. That's why value is the same. Look at this next example. Coupon rate is 10%, but the market rate is 13%, which is greater than the coupon bond you're holding. In this case, bond is discounted. Why? Because if you sell this bond and take $1,000 and buy a new bond, you will get 13%. So nobody will going to buy your bond, which has 10% interest rate, and in the market is offering 13%. The third example, you're holding a bond at 10%, but required rate is only 7%, means if you go and buy a bond today, similar risk bond, you're going to get 7%. So now you can sell the bond you're holding at a higher price, and bond will sell at a premium. This exhibit shows the relationship between bond and the interest rate changes. And one of the important thing I want you to remember is, as the bond reaches the maturity, all the bonds are going to receive the same amount, which is the maturity value. So as the time passes by, the premium or the discount gets closer, and eventually all the bonds will receive $1,000 maturity value. Let's look at the yield to maturity of a bond. Yield simply means rate of return. Yield to maturity means rate of return assuming that you're going to hold the instrument until it matures. In this example, the interest rate is given to you, which is 10%. Maturity date is given to you 10 years. Current price of the bond is $1,050, and your goal is to compute the yield to maturity. We're going to use the bond valuation model to compute the yield to maturity. Value of the bond is $1,050. Interest payments are $100. Maturity value is $1,000. And we know it's for 10 years, and we are solving for interest. You can use a financial calculator and compute the yield to maturity. 10 and 1,050 negative PV and 100 payments and 1,000 future value. Compute I/Y. It will give you 9.2236, which means based on the current price of the bond, and if you buy this bond today and held this bond until it matures, you're going to make 9.23% rate of return or yield to maturity. Although the bond's coupon rate is 10%, because bond is selling at a premium, when you buy the bond, you're going to make only 9.2236% in yield to maturity. I have shared a spreadsheet on bond analysis. I want you to review this spreadsheet. Again, the spreadsheet has 3 sections: input, process, and output. Do not change any formulas in the process area. Enter the par value, interest rate, and the required rate. The template will calculate the fair value of the bond. This template also have bond yield to maturity analysis, current yield analysis, and yield to call analysis, and also zero coupon yield to maturity. So I want you to look at how I've created the spreadsheet, learn how to enter the formulas and analyze the bond value and the yield to maturity. Now let's look at the common stock valuation model. This model is also based on the same basic finance concept, that value of any given asset is the function of present value of the future cash flow. When you invest in common stock, you will receive dividends and capital appreciation, the price change over a period of time. Let's first understand the future of the common stock. Number one, claim on income. As a stockholder, you're owner of the company. You have the claim on the income of the company, your claim on the asset because you're owner of the company, and you also have the voting right. Using the voting rights, you can hire, fire managers and make decision, help in making decisions. You also have preemptive rights. Okay, for example, a company issuing additional shares, you have the right to buy shares. Also, you have limited liability. What do you mean by limited liability? When you invest in company, you're part owner. Let's say you invest $5,000. You're liable only for the $5,000. If the company goes bankrupt or somebody files a lawsuit, nobody will come after you except the money you have invested in the company. Okay? Let's look at the common stock valuation. Typically, you're going to find four types of common stock. Declining constant growth means this company's growth is declining. Zero growth, the company is not growing at all. And most common you're going to find is normal constant growth. For example, a grocery industry, clothing industry, or any consumer product industry falls under the normal constant growth. Okay? The next is the differential, supernormal, or variable growth. A good example is the technology company. Okay. Now, you're also going to find declining constant growth because some industries are changing and eventually they're going to, die. Zero growth most of the times are subsidized industries, and a lot of times is by government or some agencies. They want to make sure that we have the know-how. For example, there are a lot of agriculture segments are subsidized and they are not growing, but they exist because we need that know-how. Let's look at the steps involved in calculating the fair value of the common stock and the common stock valuation model. First step is learning how to compute the dividend for the next period. D1 means dividend for the next period. D0 is the dividend for current period. We have the information on the current dividend most of the time. You take the current dividend, which is 0, multiplied by 1 plus G. 1 plus G. G is the growth rate. The common stock valuation model, again, P0 means the current price or the fair price today, the present price, or expected price. Function of the dividend for period 1, 2, 3, 4, 5, and so forth. So what we do is we bring all the dividends to today's value, and we also add the present value of the change in price. That will give us the fair value of the common stock. But the first model is called constant growth model. In the constant growth model, we assume that growth is constant. If the growth is constant, we modify the model as D1, which is the dividend for period 1, divided by RS, which is the required rate, minus G, which is the growth rate. Using this model, we can find the fair value of the common stock if the company is going through the constant growth rate. Okay, let's look at the common stock analysis example. Current dividends are given to is $2. Required rate is 13%. Growth rate is 6%. Question is, what is the fair value of the common stock? Look at the bond valuation model on the right-hand side. The bond valuation model states that dividend for the next period, which is D1, divided by required rate of return minus the growth rate will give you the fair value of the stock. So let's use the information given to us and then compute the fair value of the common stock or expected value of the common stock. P0, or the expected price of the common stock at period 0, which means today, equals to $2 is the current dividend. To compute the dividend for the next period, which is D1, we multiply 2 times 1 plus 0.06. And then divide that by required rate, which was given to you, which is 13%, 0.13, minus growth rate 6%, which is 0.06. That will give us 30.29, which means based on the information given to us, $2 dividends, 13% required rate of return, 6% growth, the fair price is 30.29. Now, you can use the same model for a negative growth or zero growth. Whenever we have negative growth, we go ahead and change the G as negative. Or if it's a zero growth, substitute G as 0 and then solve for the expected price of the common stock or fair value of the common stock. Next, we are going to learn how to compute the required rate of return of a common stock. In this example, dividends are given to you $2, growth rate is 6%, and the current price of the common stock is 30.29. And our goal is to determine the required rate of return. And using the formula for the required rate of return, which is D1, which is the dividend for the next period, divided by current price P0 plus G, growth rate. All the information is given to us. We are going to substitute that in the formula. But the first step is to compute the dividend for the next period. $2 are the current dividend, and the growth rate is 6%. So when you multiply 2 times 1.06, that will give you the dividend for the next period. The dividend for the next period is $2.12. Now we are going to use the formula, and $2.12 is the dividends, $30.29 is the price. We're going to divide that, then whatever the product we get, we are going to add that to the growth rate, which is 0.06. That will give us 13%. So the required rate of return for the common stock is 13%. Next, we are going to look at the non-constant growth common stock. The information is given to us is the dividends are $2. Constant growth is 30%, and constant growth is going to last for 3 years. And after that, the company is going to back to the normal growth or the constant growth, which is 6%. And the required rate of return is 13%. The question is, what is the fair price of the common stock? In this example, we are going to learn the steps involved in computing the fair value of a common stock, which is experiencing variable growth or non-constant growth, okay, or sometimes we call as supernormal growth. The first step is to draw the timeline. This way we understand what is going on. Looking at the timeline, we know that the company is going to experience non-constant growth or the variable growth for the 3 years, and then the growth is 30%. So if you look at the timeline for the first 3 years, company is going to experience 30% growth. But at the end of the third year, they're going to get back to constant growth. To compute the fair value of a common stock experiencing non-constant growth, first step is to bring the present value of all the dividends during the non-constant growth period. So if you look at the timeline, we have calculated the dividends for period 1, 2, and 3. And then we are computing the present value of those dividends. And once we have the present value of the first 3 years dividend, which is the constant, next step is to determine the fair value at the end of the third year using the constant growth model. So if you look at under year 3, we are computing the price of the common stock using the dividends, and the required rate of return was given to us at 13% and the growth rate 6%. That will give you the value of the common stock at the end of the third year, $66. So we need to bring this $66 to today's value. So we compute the present value of $66, and that will give you 46.11. And then we have computed already the present value of the dividend for the year 1 as 2.3, and present value of year 2 as 2.64. Present value of dividends for year 3 is 3.04. And then when you sum that up, it will give us 54.1067, which is $54.11. So the fair value of the company is $54.11, assuming that the company is going to go through 3 years of non-constant growth and then start the normal constant growth at the end of the year 3. Next, we are going to learn about the preferred stock valuation. Preferred stock is referred to as hybrid security because it has features of both debt and also the common stock. Okay? To compute the fair value of the preferred stock, we need to the dividend rate and also the required rate. So let's assume that this stock is paying 5% dividends, par value is $100, and required rate is 10%. So if the dividend is 5% and the par value is 100, the dividends are going to be $5. So first we compute the dividends, multiplying the par value times dividend, that will give you $5. Next, using the model for the preferred stock valuation, which states that dividends divided by required rate gives you the fair value of the preferred stock. So $5 the dividend, and 10% is the required rate. So when you divide 0.10 into $5 gives you $50. $50 is the fair value of the preferred stock. Let's look at the required rate of preferred stock. Preferred dividends are given to you as $5. Price of the preferred is $50. Question is, what is the required rate of return? To compute the required rate of return, we take the dividends divided by the price. In this case, dividends were given to us $5, and the price of the stock is 50. 5 divided by 50 is 10%. 10% is the required rate of return of the preferred stock. I have shared a common stock valuation and the preferred stock valuation spreadsheet. Again, this spreadsheet is also divided into 3 areas: input, process, output. Do not change any formulas in the process area. Use this spreadsheet to learn how to compute the fair value of the common stock, required rate of common stock. You can also see the zero growth stocks or negative growth, supernormal growth or the variable growth, and the preferred stock value and the required rate. So all the analysis is in this spreadsheet.